I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Jim, good to be with you.
Well, former and current heads of the U.S. Fed huddled up, had dinner, and what did they decide should be done or could be done?
Well, I think they all renewed their vows to preach credit expansion, and they think that credit expansion prompts business expansion, but that doesn't work. So they're left just to promoting the stock market, and central bankers, even retired senior central bankers, out promoting stocks is really rather unseemly, but it shows more a desperation, because to take it from the start, their theory is that, well, way back 100 years ago, those that started the Fed noticed that when you have a business expansion, you'll also have a credit expansion. So you got two things happening at the same time, and they consider it's causal rather than correlation. So then the theory ever since is that they push out credit, and that will amount with a certain amount of GDP growth, and it just isn't working. So this is where you've gone down to zero interest rate policies, and now down in many countries to minus interest rates. So the minus interest rate shows that the theory isn't working. They're applying the same theory. I remember years ago hearing something about the prosecution of World War I, and they kept bombarding with cannon, and then Russia, the troops over the top, and the attrition. And somebody wrapped it up and said what the generals were doing in World War I was that they were trying to remove a screw from a board with a claw hammer, when the screwdriver is the tool. And the screwdriver in World War I turned out to be the tank, which provided the mobility that was needed to end the stalemate. Now here's what you've got in policy making. These guys have an intuition, and that's all it is. And the intuition is said that pushing out credit causes a business expansion, and it isn't. So it's time for the generals and the central banks to come up with a different tool. I was about to say a new tool, but it's a different tool. The old tool is just stop trying to run the economy. All they need to do is maintain a reserve behind the currency so that the currency has some value, and the markets and the economy can look after itself. But you have this tremendous audacity whereby a set of fools, now this is around the third generation of fools, have assumed that the economy can be managed, and the subset of that is that they are brilliant enough to manage it. And it's built in. It's three generations of central bankers now have been on that theme, and it doesn't work. So how does it end? Well, I think the next phase of the credit contraction could be starting. We've had credit spreads narrowed terrifically out of the panic into January, when they were beating up all the stock markets and all that sort of nasty stuff. And then you've had now a terrific narrowing of credit spreads. The best since the turn started to adversity in June of 2015. So this now, in the last week and a bit, has reversed. So you no longer got spread narrowing, and you have it's reverse trend. So it's like when we were in July last year, where we're looking for the second breakout in credit spread widening, and that is yet ahead of us. We've had the first breakout, and then financial markets were rather heavy yesterday. So a number of, as you said, introduced with former Federal Reserve chairs were at a dinner and all come out and said that they would try to keep the party going. And I don't know, I think the Federal Reserve quite likely, since it opened indoors in 1914, has never deliberately tightened. It's always been there to accommodate speculation, because they've got this theory that if you prevent, well, back it up a bit, and they noticed that if you had a severe hit in the financial markets, it would be followed by a recession. So then their intuition has been that if you prevent the hit, you won't have a recession. And so you've had many hits to the financial markets, and you've had 19 recessions since that theory was introduced in 1913. So it's, to wrap it up on this part, it's just plain not working. And every time the markets falter a little, I think the central bankers have a coordinated policy to go out and say bullish things, and they get a pop in the markets because it is an artificial move, and it forces some short covering. And that rally out of January was brutal short covering. My gosh, but it was, we had covered, and we're looking for a rally because everything got so oversold. And then more recently on the stock market, we've got a special model, works both either way, and we call it the springboard. And in a declining stock market such as recently, and you get a reaction rally in it, then that, we call it the inverse springboard. And over the last week, the rally became sharp enough that it's generated the inverse springboard on a number of senior indexes. And it's similar. This is the first big rally out of a major hit to the market, and it's similar to November of 1973, and the 1973-74 bear market was the worst since the 1930s. And it's also similar to the rebound out of the first part of the crash in 1929. I can't remember which month, but in the 1930s. So it's a similar, let's put it this way. When we've had this signal in the past, it's been within some rather severe bear markets. But we want to back up even one more on that, is that when it works as the springboard buy, that's designed to, when you had a quick decline in a generally rising market, this gives the springboard buy. And the last one we had on that in the bull market was in October 2014, and then that led to the peak in 2015. So here we are now. You had the hard sell-off, the rebound, giving a springboard sell. So we'll watch and see how it works. But at the moment, looking at today, the policymakers really have prompted a little short squeeze in here, and it could last into Monday, Tuesday, but we're looking at some very powerful technical signals that suggest this rebound rally is in the process of rolling over.
We'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Bob Hoye. Bob, someone suggested that if the U.S. dollar by some miracle fell by 10% one day, very quickly, that perhaps it would boost the market by 10%. Is there any kind of correlation like that?
Yeah, it's not really tight, because you do have an intrinsic value in the stock market, but the market's appraisal on that will shift over time. And it's the same theory about pricing of gold, that if the U.S. dollar goes down 10%, gold will go up 10%. And even in hyperinflation in Weimar Republic in Germany in 1922-23, the two items that did perform the best in that hyper-inflation was the stock market and gold. Anything else, they couldn't adjust the price fast enough. And then once the hyperinflation was over, all those assets went down. So I think it's just a variation on what they believe at the central banks. Depreciate the currency and the stock market will go up or whatnot, whereas in the 1960s and 70s, the establishment was adamant that their expansion of money supply didn't prompt inflation. They used to argue that inflation was caused by rising wages or by costs going up, and Milton Friedman broke the spell when he up and said that inflation is purely a monetary phenomenon, and that shook the street up something awful. It was fascinating. But to get back here now is that it does work sort of that if you have a rapid depreciation in the currency, there will be upward pressures. But then you've got other consideration in financial markets. You've got cyclical events, and you also have seasonal events. When, of course, we're in as far as the financial markets, we're in the sensational season where, different asset classes can really soar in March and April, and then you've got the old saying about sell in May and go away, and that one works reasonably well. But today, of course, crude oil's up $2.25. You've got the Dow up, and you've had gold's up 4, silver's up 17, copper's up a penny. So it's not huge, but it is a bit of a relief rally. So what we were looking for, using the S&P, for example, is with this signal, the inverse springboard, what you want now is on a weekly chart on the S&P, a lower low than set in the week before. We've had a lower high than the week before, but we still haven't had the lower low. So who knows, maybe next week on that one. And then on the precious metal sector, which has been outstanding, for example, the old Hoye index, gold share index, it was at 99 and its low in January, and it's been up to 189. That looks like a 90% rally, if my arithmetic is correct. And it's got good momentum, and the gold stocks have been sort of trading in a narrow range for a number of weeks now, but that percentage gain, it's going to be corrected, a setback, or will it be corrected over in a narrow trading range for a number of months? Who knows, really, but my guess is that there'd be a pretty good price correction in the gold stocks. And I think the rally in gold itself was up about 23%, so it shows again that if you get the directions right, it's a much happier experience being in the gold stocks than in the bullion prices, bullion itself. But one should always have a little bullion as insurance. And but for the whole gold community that really is adamant that you can get even with the Federal Reserve by owning gold. Tell me about it from 2011 to January. That theory didn't work. So gold really is, if you're looking at it in U.S. dollars, which most people do, it's just trading a currency against gold. Whereas if you're in the stocks, the gold stocks, you're looking at an investment, and with the producers operating and margins improving because the price of gold has done better than the price of many commodities, like the price of crude has fallen quite a bit relative to gold, and it indirectly is a reflection of the energy costs of mining. You know, you've not just got fuel for trucks and things like that, but also it's tied to the blasting agents you may be using, are all tied to energy. So, and the gold mining has had its best innings in a post-bubble contraction, which we're in. The bubble peaked in 2007. Then you had the worst calamity since the 1930s, and you're on the first business cycle out of that panic in 2009. It's been a long one, and it's getting pretty aged now and mature and running out of abilities. And the stock market, of course, it's at its high. If you look at the NYSE comp, it's at a big rounded top, and this is a rebound, as we said a little while ago. Like the rebound into November 1973, and then the rest is yet to follow. So somewhere in the next week or so, current strength in the stock market should just fade away, and the stock market can enter a pretty good decline. And that would be tied, as it was last July, with the credit spreads taking the second breakout in the trend to widening.
What about the gap between so-called paper gold and real gold? Should you just be satisfied?
Oh, that's something that entertains the gold community analysts, and it doesn't amount to much. You had the merchants in London in the 1500s, the 1600s, were all lending gold and money and everything else. So there's always been some sort of paper representative of gold. But I know that certainly since I've been in the business, the 60s and 70s, so after the 70s, when you then started having a future price of gold, the lofty gold community in London that traded on this strange gold pool committee, they got sort of antsy about it, but I just see it as just another way to add liquidity to the whole thing. It's a bunch of purists who go on about differences between paper gold and real gold, and they seem like many gold bugs are there. They assume that that the Federal Reserve, immoral policies of attempting currency depreciation is going to favor gold all of the time, but the crash and bear market in gold from 2011 to recent, and even worse crash in silver is pretty well Well, let's look at it in two ways. It pretty well put away the idea that gold goes up as the Fed tries to depreciate currency. And then the other one, of course, that is always fascinating is the silver community, who always looks at the supply-demand, and every year silver's in a deficit. There's more consumed than there is mined, therefore it should go up all the time. And this is the one thing that the bear market since 2011 in silver has done, or should have done, is got a large part of the community, the gold community, the precious metals community, out of trying to figure out where the prices will go by analyzing supply and demand. It is so dangerous to analyze any metal on a supply and demand basis. What you want to look at is what we do, is look at the business cycle, the credit mark cycle, and use the best of technical analysis, and just be very content in saying, oh, it's oversold, rather than saying it's purposely been driven down by a conspiracy. So it's a fascinating subject. Maybe we can continue on this one next week.
Bob, thanks a lot for chatting with us.
Good to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions or comments for the show to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.